You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Tuesday, 25 August. We've got Goldfields H1 results due within the hour. I'm Simon Brown, coming at you live and loud from the Moneyweb studios in Gauteng, Johannesburg. On the show today, Peter Redenhurst, Herenia Capital Advisors. MTN results, which seem to have the market confused. And, a 6 billion rand share repurchase. We're going to be chatting with Stanlib Asset Management, what really drives returns on the JSE. And then Itatal's CEO on results as revenue and profits fall, but they do pay another special dividend. Revenue was up, but at 0.6%. This podcast is brought to you by Stanlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines: Moneyweb: CFDs are more complicated than the buy button suggests. Understanding the product and the provider is essential. Business day: BHP hits 4 trillion rand JSE valuation. Iron ore overtaken as group's biggest earners as copper fuels the outlook. Morning markets: US was red, S&P down 0.3%, Nasdaq almost 1% lower. The East is mixed. We've got Sydney just over 0.5% up. Tokyo's green, not a lot, 0.1% green. We've got Hong Kong down almost 1/3%, and Tencent off 0.1%. Commodities mostly red. Gold futures the exception, 4,735. Brent is 92.28. Platinum 1,867. Palladium 1,368. The rand is 16.02. Bitcoin 80,700. Top 40 opening call. Red open 590 points, or 0.54% lower.
Moneyweb Now, on the money. Also available on podcast.
Chatting now with Peter Redenhurst, Herenia Capital Advisors. Petri, appreciate the early morning. The M10 results, as I said in the intro there, I mean, initially the share shot to 205 and then ended up closing red below 190. I thought the numbers weren't bad. Massive share buyback, 6 billion rand. This is in a stock that's, almost tripled off the 2024 lows. Your thoughts on the numbers, your thoughts on a really chunky buyback?
Good morning, Si. And as people read more and more of the trading statements, numbers, I think the share responded a little bit. It's a bit confusing, you kind of mentioned. I mean, if you look at service revenue rising 17.5% in constant currency, right? Mm-hmm. And adjusted HEPS grew 21%, but reported basic headline earnings per share, it was down.
Yeah.
Right? And obviously, so there's a lot of things going wrong. There's an impairment when you run a game. I think that, this time, I believe it or not, MTN didn't actually do anything wrong, but geopolitics sort of plays the game it plays, and unfortunately, MTN stands in the way of that. So they have to essentially write down almost 4 billion impairment, 3.9 billion cash impairment for their run and sell business. So that's obviously not great news. One of the bigger things that I think was good news was essentially this, right? Subscribers up 6.7%. So there are now 317.7 million
big
people
number
subscribed to MTN. That is insane. 179.3 million of them are data subscribers. Mm-hmm. So data revenue grew by something like 29%. To 57 billion rand. Mm-hmm. And the other big thing is the fintech transaction volume. The Momo product that they have, that grew to 13 billion transactions that they did, valued at about $330 billion US dollars. So that is massive, right? I think this is something that if we rewind the clock many, many years, we spoke about how fintech companies eventually become banks, right? And this is happening.
Yeah, no, fair point. It is happening, and that's a great point. I mean, I was one of those who was like, I was skeptical of it. It is happening. 6 billion share buyback. I zoom this chart out. This was a 75 rand stock in 2024. It was a 225 rand stock earlier this year. I mean, I don't know. I give me the dividend, although I appreciate that then costs a 20% dividend withholding tax. Your thoughts on the buyback?
I think that it's an interesting move. I mean, I think it's supportive of the share price. I think what they're trying to do is, so I just want to give some context. In 2014, it's a 260 Rand stock.
Also true. Also true.
So, yeah, it's up a lot, but it hasn't really gone up to make new highs. And that could be one of the drivers, I think, why someone would want to do a share buyback, why a board would want to do a share buyback. One of the sort of things is their net debt to earnings before interest taxation, EBITDA, I'm going to say the whole thing, remains very, very low, with free cash flow up very high, and they got something like 7 billion in free cash flow. So using that essentially to buy back 31 million shares only improves their ratios, right? Because they can buy those shares, stick them back in treasury, there's fewer shares in issue, dividends going forward get bigger per individual share, PE gets better, and they get a chance of getting their share price higher up, right? To get the share price to make new highs. So I think that could be one of the primary drivers. I don't necessarily see it's a bad thing. I think that the reason the stock essentially sold off is because people said, wait a minute, I want cash. I don't necessarily want the company to buy 31 million shares. I'd rather have the value for that money, please. So that's a bit disappointing, I think, because if you think about, there's crazy people like us who are traders, who are involved in the markets, but the primary sort of person involved in the market is buying shares for a long-term investment, whether you're an individual or a fund. And dividends is a big motivator as to why you buy a particular company's shares. If you don't get your dividend, I'll go somewhere where I can. So that, I think, was part of the reason we saw the negative reaction yesterday. However, I think that if you look in 5 years from now, when there are sort of fewer individuals to pay when the dividend hits the roll, everyone gets a slightly bigger dividend.
And then everyone's happy and everyone's like, that was a nice 6 billion spend. Now I get your point, 100%. We'll leave it there. That's Petley Redenhurst here in your Capital Advisors. That's our question today on LinkedIn. Your thoughts on that 6 billion of buyback. To Petley's point, some people don't like it, but in years to come, it'll benefit everyone. Have your vote, have your say, LinkedIn. Give you money, smoother returns for Stanlib Asset Management. The Stanlib Flexible Income Fund's agile investment process preserves and grows capital in all markets.
Moneyweb now on the money.
Chatting with Chetan Ramla, he is portfolio manager in the systematic solutions team at Stanlib Asset Management. Chetan, appreciate the time as always. JC often described as a resources market, and at times I suppose maybe it is, but is that still a fair conception, or is it perhaps a bit outdated? And if it is, what does our market sort of more accurately look like these days?
Yeah, Simon, I think increasingly that perception is becoming outdated. And like you rightly say, I think if you look historically, our market has at times been very much dominated by the revy. If you go back all the way to the late 70s, so even around that 1978 and early 80s period, for context, resources made up around 68% of our market.
Oh, wow.
But I think since then, over the last 30 years, there's definitely been a broadening out. So if you look at how our banks have done, our financials, consumer staples, industrials, etc., there has been this great broadening out. But once again, like you say, it is cyclical and it moves through time.
Yeah.
Currently, in fact, with the massive run-up in gold that we've seen, miners have dominated the market. So at the moment, I think the resi is sitting at about 30% of the all share. But once again, that does vary through time, just as the market evolves.
I get that. I mean, it is. I mean, markets are in the different parts of it cyclical. You also, in a recent article you wrote, you're talking around how the JSE actually might be more diversified its sector, yet we're still seeing concentration perhaps at company level. That distinction is that we've just got some big stocks in our market, and that's not even unique to us for that matter.
Exactly. It's quite an interesting sort of interplay where the JSE has definitely become more diversified, across the range of sectors that it represents. But what we've seen is that it remains quite concentrated in a relatively small number of companies. So for context, the 10 largest shares in our market account for roughly half of the market value. So that just shows you how sort of concentrated we are at a stock level. And once again, this changes over time and leadership changes over time. If you go back to 2002, that was when the modern set of all share and the modern all share index was set up. Very interestingly, there have only been 24 unique companies that have appeared in the top 10 since 2002. So that actually gives you a flavor of sort of the relatively small number of names that do tend to lead.
Yeah, I would never have guessed the number was that small. I would have thought maybe 100 or so. You made the point that the concentration risk should be assessed through sort of underlying return drivers. Worry less about the sectors, worry what that return driver is, and then plug that into portfolio construction.
Yeah, this is so crucial, Simon, because I think it's very easy to get fixated and just simply look at the sector labels, Resi, financial, staples, etc. And then by looking at those labels, you think that you are diversifying away your risk as an investor and you're sort of broadening out your risk exposure. But actually, you need to go deeper. And when you go deeper, it's to actually understand what is driving these companies. For example, companies that are in one sector or amongst, it might seem on the surface, different sectors, you might find that they all have underlying exposure to the rand or to Chinese demand or to the commodity cycle. So in essence, you are actually doubling up on risk instead of diversifying risk, as an example. So investors need to start assessing diversification across several dimensions. And that's not simply sector exposure, but rather think in terms of currency sensitivity, think in terms of geographical earnings, macro risk, and then also the relationships between these risks. So I think genuine diversification really comes from holding different sources of return, not simply focusing on sector labels. And I think that's really the key.
I get that, absolutely. I like that. I mean, you mentioned China, and that's obviously, there's Process on the one side, there's Richemont on the other, and we could put, an iron ore company in the middle. They're different sectors, the same driver. If we look ahead, and if the JSE is going to continue to evolve with different leadership, not as much as I had thought, but still there, what does remain consistent in that process? I mean, your systematic approach, I suppose it's having that process perhaps as important as anything.
Yeah, so I think most important, because as we've seen and as you've seen different cycles of the market play out, the market itself changes. And I think it's especially now more than ever, the importance of having an investment framework and a solid process to make decisions is actually what's needed. So it's almost finding that anchor in the sea of change that keeps unfolding, because really that idea of having a framework, Simon, is so crucial, especially when there's so much noise in the system. And that attempt at separating signal from noise becomes ever more important, because as we've seen with social media and all of the noise that's going on in the news, it's becoming increasingly difficult to know what's real valuable information and data and what's simply fluff, noise, and froth in the system. So I think understanding leadership in terms of what drives returns and companies will change, but having that disciplined and adaptable investment process is really the key at the heart of it.
I get that, absolutely. I mean, and you're a portfolio manager in the systematic solutions, and that is your process, that is your framework. But I'm imagining there's still some human judgment. You're just trying to sort of make that an easier process for the individual.
Yeah, I think, this point, especially if you look at how the whole technology theme is playing out at the moment with AI and all of these amazing technologies, Simon, now more than ever, the skill of the human manager is paramount.
Yeah.
By no means is human judgment being pushed aside, but rather by having a solid framework and having a systematic approach of making decisions, when you combine that with the excellent tools and technologies we have, in a sense, it sort of enhances and strengthens what we can do as skilled human managers. That's really the heart of why a systematic approach really creates a structured and consistent way of assessing companies. And that's really it. And why that's so important is that it ties in very neatly to the risk management dimension. You'll find that with managing these types of portfolios, building strategies that do outperform over the long term, these really become multidimensional problems. If you look at all of the noise, like I mentioned, you're trying to find companies that perform well while simultaneously accounting for various risk dimensions and risk factors. It's actually a near impossible task to just do in your head or to do in a sort of heuristic way. And that's where the need for sophistication comes in. And human judgment is paramount in terms of designing these processes. And it's part and parcel of the process. But it doesn't mean we can't use these sophisticated tools that are now at our disposal.
Yeah, and just using the best parts of both, whether that be the tools or whether that be the humans. We'll leave it there. It's Chetan Ramle. He's a portfolio manager, systematic solutions team at Stanlib Asset Management. Appreciate the time. Let your money weather the storms with Stanlib Asset Management. Invest in the Stanlib Global Select Fund, a diversified all-weather equity portfolio submanaged by JP Morgan Asset Management. Think SARS isn't watching? Think again. Join Moneyweb editor Rake van Niekerk in conversation with SARS Commissioner at the Money Summit. Together they will unpack how SARS has transformed tax collection through AI-powered audits, third-party data matching, and tougher compliance measures. Find out what every taxpayer and business needs to know. Tuesday, 1 September at the Sandton Convention Centre. Register for free using promo code MONEYWEB. Visit moneyweb.co.za and secure your seat today.
Moneyweb now. On the money.
I'm chatting with Brandon Wood, Total CEO. We had results for year-end 30 June. So revenue up 1%, HEPS off 9%, dividend down 10%, a special dividend of 25 cents. Brandon, let's start with that special dividend. I'm guessing the actual dividend is a reflection of HEPS. You've got a lot of net cash, 1.7 billion. That certainly caught my eye as I was running down the results highlights. Hence the special dividend for shareholders and second year in a row.
Yeah, I think if you look at our track record over the last few years, we've got a record of returning money to shareholders. I think the reality is our business remains profitable and highly cash generative, generating cash obviously in excess of our requirements. So it's a deliberation with the board every year with regards to what we do with the surplus. And, one of the preferred routes, of course, is to return to shareholders, and we've done again this year. Obviously a bit more conservative in light of the difficult trading conditions, but, in all honesty, not really something to do.
Yeah, I want to come to the trading conditions. Very, very cash generative. You make that point. This is a very cash generative business, even in tougher trading conditions.
Yes. I think we've got quite a unique business model, given our property holdings, the franchising network, our services incomes, royalties, etc. So generally, sales through the business have quite a good profit multiplier with the vertical integration. It's a very strong source of our balance sheet strength is just the way this business is structured.
Yeah, absolutely. Ceramic Industries, in much sense, is the story of these results. Manufacturing trading profit down from 507 million to 322. That's a little over a third. Capacity utilization down at 70%. How much of this is dumping? And we'll talk more about ATAC in a moment. How much is consumers under pressure or internal? Because this is perhaps the key pain point.
Yeah, I think a lot has to do with the extent of the increase in competition in the market. Now, there are part of the market that are very resilient, particularly at the lower end, where there's still good building activity in the informal sector. That's a space where we've seen quite a lot of competitors pop up with these Chinese offerings, the African factories. We know how much it costs to make a tile. We see the cost at which these tiles are coming into the country. So for sure there's dumping. That's opened up access to product to a lot of competitors there. So, it's a commodity, yes. Every retailer that they supply is very, very similar product, but it's also price. And price-sensitive customers would take up that option. So for sure there's a large part of that struggle from a volumes perspective is down to that. And of course our exports markets as well. I mean, these guys are in the countries we export to, and they've managed to get themselves protection at the borders. So we now export product into those countries. The cost of our product is inflated by quite a bit. So those countries have moved a lot quicker than we did to put in place the protection. And that's also had quite a significant impact on ceramic industries.
It absolutely has. I mean, ATAC has brought in anti-dumping. It came in last month. It's only for 6 months. So that's why my understanding is why they sort of get more information. Does this help materially for the next 6-12 months? Or, I mean, it's nice, but is it going to make a material difference in the immediate?
Yeah, I think it's not really something we're hanging our hats on. I mean, firstly, the first issue is already prior to the provisional duty coming in place, there was a lot of stock in the country. These businesses have local companies with big warehouses. Good volume of stock is probably sufficient to last 2 or 3 months. And I think the other way is one thing, enforcement is another. And they find ways to circumvent these things. And we already are aware of certain practices that are taking place to avoid the duties, which we will, of course, still deal with in the relevant channels.
Looking at retail, and you mentioned the shopping down, retail, frankly, looked a little better than I thought. I mean, we've had the massive fuel price increase, although that would have been for, 3 months of the 12-month period. You are seeing, I imagine, customers shopping down, but retail remains moderately robust.
Yeah, I think what's important for us in the retail space is really to provide an offering that customers want. And that's location, that's service, the actual product and fashion, etc. So, there's a lot of work that goes into the differentiation. As I mentioned, some of the competitive product out there is really commodity-based.
Yeah.
We try and create an aspirational basket for our customers. We have brands that are trusted, so that attracts customers too. And yes, they shop down, but we also, given our spread across the market and even within stores with our price laddering, we are able to cater for customers that are perhaps a bit more price sensitive and cannot buy up. We have an offering for everyone.
Yeah, and that perhaps is the key point there, is that offering for everyone. We'll leave it there. That's Brandon Wood. He's Total's CEO. Appreciate the time. That's it for today. Yesterday we were chatting with Jimmy Moyoha. We were talking Cell C results from Friday. Stock trading slightly below its IPO price from, November of last year. We asked if there was value in South Africa's smallest telco. Almost 2/3 said no, stiff competition. A fifth said yes, looking good. And the rest of you said you preferred others. Have your vote, have your say, LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning, the Moneyweb website and the app, 6:30 a.m., podcast just after 7. Thanks to my team, Eddie, Nobohle, Nicole, Sabu, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. We'll chat again tomorrow. Master drilling results.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.